Hello and welcome to the Mutual Fund Show. My name is Niraj Shah. Over the next 20 to 25 minutes, we will talk all about mutual funds. Now, it's peculiar. Today we've got three very good guests. First off, on the fund side, each of these, when they come on the Mutual Fund Show or otherwise, give us a lot of insights. The two of them together from the Aditya Birla table to tell us their thoughts on the current scenario for investing at large, but also the NFO that they are coming out with, which is the Aditya Birla Sun Life multi-cap NFO. So both Bala and Mahesh Patil will talk about that. And then post that, we will also get in a very special guest on the advisor side. Vishal Dhawan would be joining in, speak about his thoughts on, of course, his view on the NFO as well as we usually do, try and get you a sense of some of the best performing flexi-cap funds or large cap funds that you can invest into and funds that you should avoid. But first, kickstart the discussion with Bala and Mahesh Patil of Birla Sun Life. They need no introduction. Gentlemen, both of you, thank you so much for joining in. I'll throw the floor open to questions at the start. Either of you can kickstart this. But I just want to start off with, how do you feel from a mutual fund investor's perspective, the current investing landscape? Because everybody's caught between this uncertainty of how there are rising COVID cases in India, even though not the world over. But yet the vaccination drive is going to start in full steam from the 1st of May. So how do these two push and pull lead from an investing perspective?
Yeah, I think Niraj, it's something. It's an interesting trend that we are seeing. The repeat of second wave of COVID definitely has put many citizens of the country a bit on a tenterhooks and increase the worry among people. Therefore, this is something one has to pay attention seriously as something related to the health, as we have seen in the past. But at the same time, the effort that is being put in by the government in terms of going for a partial lockdown, and lockdown actually varies from different state to states. At the same time, keep the economy going and continue to provide necessary support that needs to be provided both to the citizen on the one side and other side on the economic, the growth coming back. I think if we go by that model, definitely what we have seen in the year beginning 2020, April 2020, when the pandemic hit the world first time, a lot of unknowns were there. I mean, many things that we are not knowing how to address it, how to handle it. But at least this time around, while there has been a rise in cases, they're also able to take some of action that I think can bring in a solution to some of these issues. And at the same time, from the economic growth perspective, whatever the steps that they took, especially in the last 1 year, in terms of making the interest rates low, in terms of increasing the liquidity, at the same time giving more support actually to the borrowers from the banking systems by way of giving moratorium and so on and so forth. All these things I think have already started playing in terms of having a positive impact on the economic growth. Maybe the current pandemic situations may probably take a bit of backseat by 1 or 2 months. As you rightly put it, I think vaccination drive also is going in a full swing. Probably the number of people are getting vaccinated in the last few weeks, I think, have gone up quite tremendously. Therefore, these two things I think going simultaneously, with the number of cases, COVID cases coming down, the vaccination rates going up, and the continued low interest rate regime to drive the economic growth and push that is coming from the government on various spending needs that they are taking. All of them, I think, should actually make it, after a few months, really impact on the economic growth. So that's the way I see it. I think it's more of temporary, they are saying, but I think growth should come back, as we have seen in the past, V-shaped recovery. I think probably we are on that way to on that path.
Mahesh, you want to come in and juxtapose this, both not just for an Indian investor, but also an investor who has a choice between investing into India versus investing in global funds?
Yeah, so as Bala mentioned, yeah, clearly the second wave has kind of slowed down the recovery. What we are looking at, the economy was recovering very quickly here also and globally. But I think if you look at it as, and the protocol is very well laid down in terms of how to handle this. So there is an end to it. Like, unlike in the a year back, okay, we didn't know how it will pan out. So it's a matter of 1 or 2 months, okay, where you will see an impact because of the lockdowns, okay, which could be there. But I think there is an end to it. And market, interestingly, is willing to look beyond the 1 quarter and look at the slightly medium-term outlook. At the same time, I would say that the global environment is still fairly good, conducive. global growth, I mean, global, we already see the peak of the virus curve, and there's a sharp rebound in the economic growth. In fact, this year, the global GDP growth has been increased now to around 6%, which is the highest in many years. And overall financial conditions continue to remain fairly benign. So while foreign investors would be slightly worried about the second wave and the ground situations, but if anybody is coming with, say, a 1 year view or a medium-term view, I think for them, I think it doesn't really change much, because we don't expect any material change to our FY23 earnings outlook because of the second wave. It'll impact a bit in FY22 numbers slightly. We have yet to establish that impact. But for investors, I don't see any major pullout. No? Even for foreign investors, long-only investors, I think, in fact, any correction in the market would be looked as an opportunity to really buy, because that will make the market more attractive. And I think the recovery also from the second wave in terms of economy should be also equally swift, I would say. And the government would also do its bit, right, to support the economy. It means that probably the interest rates in India also will remain low for an extended period of time, and that should help to support growth come back.
Mahesh, follow up to you. Where would you reckon? I mean, the common parlance, at least in the months of Jan and February, was that try and look beyond the index. The larger activity would happen in the broader end of the spectrum. That is where the real money could be made, because the recovery would be more pronounced there. The beta would be higher. Would you second that, or would you believe that high quality large caps might still outperform compared to the mid caps and the small?
So I think we have been of the view for now almost 3 to 4 months that the breadth of the market is likely to improve. And the reason for that are a couple of things. One is we are seeing now multiple sectors looking up, right? Sectors which were down and were not doing well earlier, even pre-COVID, are seeing a cyclical upturn, be it domestic cyclical as well as the global cyclicals. We are positive on that, despite the short-term disruption, which could be caused by the second wave. And our belief is that the India's economic growth coming out of this crisis, even beyond FY22, should be fairly strong, and we should probably hit around 7% GDP growth, which, mind you, will be a pretty strong growth compared to the growth what we're seeing even pre-COVID level. We were tracking much lower growth rate. And in this period, and it is driven by multiple things, not only the easy financial conditions, government focus on stimulating growth, loose fiscal policy, and also sectors like real estate, which has been in the doldrums, kind of picking up, and even the investments, whole investment cycle starting to pick up because of the government focus on manufacturing, the production-linked incentive schemes across various sectors now, which is being rolled out, that will stimulate growth. So there are multiple levers, to sustain that growth. And during periods of strong economic growth, we've seen that the earnings growth in the mid cap and small cap is much stronger, and that segment of the market tends to do better. We saw that in the period from 2004 to 2007-8, and again from 2013 till 2018. I think we are in a similar cycle, and considering the underperformance of the mid and small cap sector in the last 2 months, last 2 years from 2018 onwards, I think there is some room to catch up over there. So I would say a broad-based recovery is what one could say, one would expect going forward compared to the narrow rally what we saw in calendar year 18 and calendar year 19. And that means good news for money managers or more diversified equity funds, to outperform the benchmark, which has been a tough task in the last 2 years.
Certainly has been. Bala, would that be the reason why you guys are launching this NFO, the Aditya Birla Sun Life Multi-Cap Fund? Please tell us a bit about the fund and the rationale behind the timing of this. Is it because of what Mahesh is saying, that the outperformance might come at the broader end of the spectrum?
Yeah, I think as Mahesh mentioned, that definitely, I think the post-pandemic, the way I think the support that's being given to drive the economic growth is making it reasonably more broad-based output that could come from the across different sectors and across different market cap. And also what we have seen in the last 2-3 years, a single side or maybe single direction growth was coming in the Nifty companies. That's the time where money managers would have gone through some tough time. But I think it looks like probably we are in a broad-based rally that one could expect, rather participation, I would say, more than the rally. So with the broad-based participation coming in, we felt there is a need to fill that gap by offering a product which currently is not in existence with us in the multi-cap category. As you rightly know, as you may also know that I think SEBI had introduced multi-cap as a category after doing a review of various type of mutual fund products that exist in the mutual fund space, right? Large cap and flexi cap and the mid cap and small cap. That is the time I think multi-cap got announced, which gives a flexibility for the money managers to choose whichever the sectors within the predefined criteria between the large cap, mid cap, and multi cap. In the small cap, that you can take exposures. So that's where I think the merit of this comes in. Second, I think historically, if you see if you take a 10-year period, I think your own chart, I was just saying it that you just put out just before. Then clearly, the longer the time horizon, if we give, that the tendency for stocks in the mid and small cap to outperform the market is very, very high. Given the fact the earning growth for companies as you go down the smaller size, the earning growth generally gets better. And because of the higher earning growth and naturally, and also the increased level of pickup that we see in economic growth, I think both combination makes it much better in terms of stock price performance product in the long run. So keeping that in mind, we want actually being in the industry for 25 years, and we look at the gap that exists in every product offering that we have. Therefore, it was felt that maybe at the beginning of the financial year, we must begin with the launch of the multi-cap fund, and that's where we have begun that. And we see a greater opportunity, not just one time. It's going to be an opportunity which is stay long, sustainable for longer-term investment purpose. Therefore, our advice to all our investors as part of this launch is to consider this fund as part of the normal asset allocation that they have between large and flexi-cap and multi-cap and the mid-cap kind of portfolio they will have allocations. Therefore, this also fits into the overall asset allocation that investors might want to consider that. So that's the purpose for which we have done. Of course, the fund is again being managed by Mahesh, Patil, being supported by another co-manager by name Niraj Shah, and he has certain plans in terms of leveraging the benefit of the analyst group, bring the best of the ideas in each of the categories, and being a part of the portfolio. That's part of the again portfolio strategy, which probably Mahesh will be able to explain in a while.
Yeah, okay. Just before I get to Mahesh Dobala, just wanted to understand, for somebody who's got exposures to, say, a flexi cap plan within your stable, etc., what's the differentiation that this brings to the table vis-a-vis something like that if the person already has a plan like that, or is planning to choose between?
I think the way I see is, Niraj, is if you take the large cap fund, they have roughly about 80-85% is in the large cap, and roughly about 10 to 12% is 15% is the mid cap. And if I take the flexi cap, generally we have the discipline of having roughly about 60% to 60% in the large cap, and roughly about 38% goes to the mid cap. Whereas the multi cap fund will probably have 35 plus 35 plus 35 kind of model, which is between the large cap and mid cap and small cap. And having said that, money manager of course can choose the segment in which he wants to go overweight, depending upon the outlook that we have for each of the segment of the market at each point of time. So that's the flexibility that he has between this category. So that's the fundamental difference that brings in order to bring in the necessary outperformance expectation that one builds in on this fund.
Got it. Okay, Mahesh, you want to comment on the stock selection methods? What will lead you to choose between the caps and even otherwise? I'm presuming when I read the literature,
Sure,
that will be a lot more bottom up than being top down. Can you talk a bit about that?
Yeah. So just to, take it further from what Bala said, I think here compared to a flexi cap, there'll be equal emphasis on large cap, mid cap, and small cap, and try to get the best ideas in each of these categories. So it can be looked as a focused large cap, a focused mid cap, and a focused small cap. A combination of these three is what one can get into this fund. And so that's what one will be looking at. And in terms of stock selection, bias would be to get companies slightly a growth-oriented portfolio, companies which have got a very strong competitive advantage, which can drive growth superior to the industry and category growth. Also ensure that companies which are much more secular in terms of their business outlook, and good filtering criteria for management quality, because we understand that this is a slightly more aggressive portfolio because of the small cap and mid cap, and we don't want to really err on the management quality because that's been a big pain point for some of these small cap names. So clearly, there's a clear filter in terms of the management quality and what we would be looking at before we enter into a particular stock. So these are some of the filters, okay, which we'll be looking at. Having said that, it is going to be primarily a bottom-up approach, and each of the sectors, like for example, a couple of themes which we are looking at, which we are positive over the next say 3 to 5 years time frame, is on the banking sector. Clearly, we like the large banks. We think that they will continue to gain market share, and our primary holdings in the banking sector will be in the large cap sector space. Then we are looking at the shift from unorganized to organized, right? Okay, which is being further emphasized by the COVID crisis. And this is a segment which is we're seeing a lot of these consumer discretionary names, retail, apparel, footwear, consumer durable companies where not only the penetration levels are low, and we see a long roadmap for growth over there, driven by higher per capita income, increased penetration, and shift from unorganized to organized. And that's another broad theme which we'll be looking at. And here, primarily the stocks would be in the mid cap and the small cap space. Then we are looking at certain themes like the chemicals, specialty chemicals, which has been doing well for the last 2-3 years. And we see a long roadmap over there because India's share of the specialty chemical global market is still around 3 to 4%, while China is around 30%. There is enough room for Indian companies to gain market share, looking at the trend of China plus one policy. So that's another theme which we like, and we look at stocks building up from that portfolio. And then finally, as I said, the production link incentive scheme which the government has announced has seen initially a good start. It's been rolled out now across sectors, consumer goods, electronics, auto ancillaries, pharmaceutical API, and that could provide additional growth avenues for companies which can actually take advantage of that. So that's another area which growth driver which we see. So these are some of the themes which secular themes which we see, and we will be trying to pick up stocks from these categories to build the portfolio on a more bottom-up basis with a slightly growth-oriented approach.
Mahesh, you reckon one final follow-up? You reckon that this would have the ability to outperform the benchmarks by a wider margin simply because, say, 66% of the weightage would be in mid caps and small caps, which typically tend to have, in a good cycle, much higher outperformance?
So it depends on what benchmark you're looking at, right? But I would say normally a Flexi-cap fund, right, or a multi-cap fund across a market cycle, if you look at it, should be able to outperform the frontline benchmark, if you say Nifty or a BSE 200, because the ability for one to invest across the spectrum, and in India, it's still a growth country. There are a lot of new companies which are coming up, either through the IPO route, which provides an opportunity to participate in the fund before they actually become a part of the benchmark. And there are other sunrise sectors which are coming up, which are still nascent, like, for example, digital. That's another sector which we are looking at, the digital transformation which is happening, the digital disruption which are happening across sectors. And there are more companies you will see coming to the market through that in that space, which definitely we will look at in this fund. And they'll be across mid caps, small caps, mainly in that space, which can enable us to make a difference over a market cycle, and potentially deliver better returns than the frontline indices like the Nifty or the BSE 200.
Okay. Bala, what would the risk be at such a juncture for anybody wanting to invest in a multi-cap fund of any kind, let alone your NF?
I think the risk which normally exists in equity investment, which of course one of the risks is, I think the last 1 year the market has run up quite a lot on hope and optimism. That hope and optimism continues to drive the market sentiment. Somewhere the market has to start looking at the earnings and the growth, the real growth that's coming in, and then followed by that earnings. And therefore, as the earning comes, generally the market goes through a consolidation phase, and probably market may not give return. But as the growth that period gets over, then you see the market again start driving. So you'll go through that kind of volatility, big rise on base of hope and optimism, then consolidation phase, then optimism returning. So the cycle in which we go through. And especially on these kind of scenarios, while the volatility in the market, if it sets in, sometimes also tend to be a little higher in the smaller mid cap space. Therefore, as long as one keeps in mind the time horizon for which one is coming in, and this risk actually can be ignored by way of understanding that yes, I'm making the investment for long term. So that's something I think one has to keep in mind, and which normally exists in any market cycle. But this market cycle, despite the earnings not being the market, given the fact the market has done exceedingly well the last 1.5 years, is mainly thanks to the power of regulator. Was something is so powerful to drive the sentiment back to normal and increase the expectation that economic growth will come back fast. And that's something also will lead to a consolidation risk that will market will go through. And that's something I think one has to keep in mind, which in my own experience the last number of years, every investment, whether it is multi-cap or large cap or any equity investment, will go through this cycle of hope and growth phase and optimism phase. Therefore, as long as one makes the understanding right and stay invested for long term, the risk can be mitigated.
Well, gentlemen, Bala as well as Mahesh, I wish you all the best for this NFO. And more importantly, I wish you all the money making ideas so that investors can benefit out of this.
Thank you, Niraj.
Now, the pleasure is ours. Thank you so much for joining me today and giving us some sense about this whole space, about the market situation right now. And of course, viewers, some sense from Aditya Birla Sun Life about their NFO and to the risks thereof. Now, as is the want of the show, we also get in somebody who's a third party expert to try and come and talk about this and give us her or his sense about this NFO. And then, of course, talk about a couple of other topics as well. Vishal Dhawan joins in right now to talk about his thoughts on a multitude of things. But Vishal, thank you so much for joining in. I hope all is safe with you. Can I please start with your view, if you have one, on this NFO that is coming in from the Aditya Birla scheme?
Thank you, Niraj. Thanks for checking in. I hope everything is safe with you as well. In general, our view has always been that NFOs need to be brought into portfolios only once they've built up a very solid track record. And there are such a large range of options available for investors today to buy into funds with track records that there has to be something very distinctly different in an NFO to be able to add in there. And therefore, I would say that, considering that the multi-cap and flexi-cap categories in general have a very large number of funds, I would actually suggest that investors wait for the track record to get built up over a period of time before they allocate, capital to this kind of an NFO. Of course, Birla has a good track record on many other schemes of theirs, and if someone's looking for specifically buying a Birla fund for some reason, then I think the flexi-cap fund with a track record already in place could be an alternative that could be looked at.
Just two questions to that. One, in which case most NFOs would get discounted, right? Because if a house is coming out with an NFO, there would always be 10 other houses which already have a product like that under most categories. So then one would probably not be able to subscribe to an NFO at all. So what would be the qualifying statistics or characteristics for an NFO to pass the muster of somebody like you, part one? And part two of my question, the fact that I hear from a lot of people that mid caps and small caps could be the flavor for the next 12 months. Since a flexi cap fund would not have as much mid cap and small cap exposure as a multi cap fund, at least in Birla's case, for somebody who wants a slightly higher exposure, could that be considered? Again, there is no saying that there is always a mid cap fund available, a small cap fund available. So options are always there. But I'm just trying to play the devil's advocate here.
Yeah, so I think the first question is very relevant because what tends to happen with new fund offers is that very rarely do they come in with something which is dramatically different from what already exists. And if you do find certain characteristics that are coming in an NFO, which don't exist amongst players in the existing space, and those characteristics you believe are likely to add value to you as an investor, I think in those cases you might want to bring that in. Let's say, for example, if you want to bring in some international exposure into a portfolio as well. And there is an NFO which combines, say, Indian equities with international equities. And you believe that you're not comfortable enough as an investor to buy a completely international mutual fund in your portfolio yet, then I think you might want to consider that, provided the fund house or the fund manager or both have good track records managing money both domestically and internationally. So I think that might be a kind of case which you could build up to invest in an NFO. Otherwise, we simply say that you wait for a short period of time. I think, in most cases, in about 3 years or so, you'll be able to, see how the fund has actually performed. And at that point, you then go ahead and invest in that fund, which is no more an NFO, but now an existing fund with a track record. To the second question around the mid cap and small cap mix, I think what does tend to happen is the advantage of a multi-cap fund in general is that the fund manager is got some very fixed rules within which there is a need to operate, and I think sometimes that's very helpful, because what could end up happening is in any investment process, if let's say one goes with the hypothesis that mid caps and small caps do very well at the time of an economic recovery, then there is a tendency to want to go overweight on mid caps and small caps. And vice versa, when you're going through a situation like we were about a year ago, there could be a tendency to want to have only large caps in a portfolio, which is a mandate that a flexi-cap fund could kind of adhere to, because it could swing to extremes on either side. Whereas a multi-cap fund will always have at least 25% in each of these allocations, and it's only the leftover after the 75%, which is 25 large cap, 25 mid cap, 25 small cap, that they have flexibility. So because the rules are much tighter in terms of the allocation mix that can be taken, I think for investors who prefer a rule-based investing style and don't want the fund manager to have complete flexibility in terms of doing whatever he or she believes is correct, I think to that extent, multi-cap funds have a role to play in this environment as
well. Okay. Well, since you mentioned that there are some proven flexi-cap, multi-cap funds out there, let me try and ask you, is there a preferred flexi-cap / multi-cap fund that you have, which you would recommend investors to invest in? Why? And why would you choose that over the others?
So one of the funds that we've been talking to investors for a long while, and I've mentioned this on multiple shows earlier as well, has been the Parag Parikh Flexi-cap Fund, which was earlier called the Parag Parikh Long-Term Equity Fund. So I think there are 2 or 3 different reasons why we like what it does. So one is, it does combine domestic investing with international investing, which we feel is quite valuable for investors who are especially starting off, kind of dipping their feet into international markets. And I think the merits of being globally diversified are well demonstrated. COVID-19, as we are going through in India right now, is a great example. So we're seeing, many other parts of the world, especially in the developed world, where the economies are starting to open up fully and go back to being, much more growth oriented. While in India, we are actually seeing a bit of a slowdown on the back of what's happening today. And I think that's exactly how international investing works, which is it gives you some protection when things that are unexpected happen as far as your primary or base case is concerned. Now, the other reason why we like the fund is because on the India side, it follows a value-oriented style. And essentially, we think the value-oriented styles are very good for investors, because what it means is that, the price that you're paying for individual stocks that you're buying are being measured and monitored very carefully, rather than just buying a growth business at whatever price it's available at. And at the same time, for the international part of the portfolio, the fund does have a tilt towards a lot of growth businesses, especially high technology businesses, which unfortunately we don't really have exposure to in India, because India is a very IT services kind of market, while a lot of the innovation and changes that are happening globally are happening in other parts of the world. So I think that's the second reason. And the third is the fact that they've been very consistent in terms of the approach that they've taken over the years of trying to ensure that they're able to keep portfolio sizes under control, get investors in to invest only, if they have a 5-year investment horizon at least, and even set up an exit load on the fund, which is typically longer than other funds, so as to disincentivize short-term investors to really come into equities, which actually should never be happening.
Okay. So, well, viewers, I mean, in an elaborate way, Vishal Dhawan is speaking about the reasons why zeroing in on a particular on that particular fund. And by the way, to both the reasons, both the international exposure and the domestic exposure, and the reasons thereof explained quite categorically. Vishal, can I do a follow up and ask you about what are the funds, and you can choose any category, but a particular category and the category or the funds within that category that you believe investors should give a miss right now. A lot of people might be, at times just investing on the basis of the stars or the rating given to the fund. At times, just given on the basis of the 1 year or the 2 year returns of the funds without quite understanding what that category is or the risk that it brings, or at times the performance that the fund has given. But maybe there are reasons why the fund may not be able to perform in the future. I'm throwing open the white bouquet at you. Can you talk a bit about that?
So I think while it's most common to want to stay away from the best performing funds or the best performing fund category, we think sometimes it's also important to even be careful about categories where the performances may not have been the best. And one shouldn't automatically believe that a mean reversion will take place, as a result of which the fund will, or the fund category will start to do better going forward. I think one of the categories that we've been giving a miss to is the thematic category of PSU funds. And while it's not a very big category because there are much fewer number of schemes in there, I think the way we've always looked at it is that the amount of intervention that happens from the government in terms of decisions that are taken can sometimes cause these entities to have to take differing actions depending on what the largest shareholder wants. And sometimes the views of the largest shareholder may not necessarily align with the views that the public shareholder could have, or the benefits that could transfer to a public shareholder. So let me give you an example of what I mean by this. So let's say if you look at public sector banks, right? So one of the things that public sector banks in a country like India do is, in spite of the increased presence of private sector banks, they have a much larger reach as compared to what the private sector banks have, and they also have a reach into a much wider segment of the population as compared to what the private sector banks have. And therefore, if there is the need for, say, for example, financial inclusion to take place, or there's a need to increase credit because you want to spur the economy back, or you want to provide money into the SME space because capital is not available enough there, then as a primary shareholder, the government could suggest to a lot of these public sector banks to actually go out and actually make those credit decisions, which may not necessarily be what a public shareholder might require, because he might be saying that the risk in those elements could possibly be even higher, and therefore we need to be able to run this business independent of what the needs of the economy might be. Similarly, if there's a need for a lot of money for the government to spend, then they may increase dividend payouts in a public sector entity, which may be actually at crossroads, because that industry that exists might actually require more capital to be infused and retained within the company itself for growth. So I think it's very important that the promoters and the public shareholder interests are completely aligned. And I think that's one of the reasons why we would say that rather than just looking at past returns And looking at things like privatization and a lot of other potential benefits that could flow throughout in the future, I think one needs to look at some of these things very fundamentally and make choices on whether you want to expose yourself to that kind of risk or not. It doesn't mean it's bad to do it, but I think you need to be aware of what you're getting into and the risks that come with some of these choices.
And viewers, I hope this gives you a sense of the kind of risk return scenario that you need to price in for your mutual fund investments or any investment for that matter. And which is why maybe, just maybe, if you are not fully in sync with the market, it pays to have an advisor who can look at all of these factors and then suggest the right fund or the set of funds for you. And I hope this kind of serves that interest in you. Vishal, really nice of you to explain this in some detail about the things that go behind some of your thinking when you are recommending funds to your clients. And thanks for the recommendation as well. I know you mentioned this in the past, but today the explanation of the thesis behind PPFAS was pretty interesting. So thank you for that as well.
Pleasure. Thank you so much. Thank you for having me over.
The pleasure was ours. And viewers, thanks for tuning into the yet another episode of the Mutual Fund